You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions@TheOptionsInsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
And welcome back to the option block. I am your host, Mark. Not Mark Longo. This is the better looking, smarter, cooler, funnier, higher voiced Mark Sebastian. And this is another great episode of the Option Block, brought to you by, of course, the Options Insider Network, where you can get this all sorts of places. If you're trying to figure out how you can download this show and you're currently listening to this show, then you're doing something wrong, because you clearly know how to download this show. You're just confused. But there are places to do it. You can go to the Option Insider app, AHA Mobile, iTunes, you name it. But just kidding. Welcome to the Trading Block. And Mark is on assignment. I've sent him to Florida again for FIA. So instead, Mike Tosaw gets stuck listening to me talk markets for the next 45 minutes or so. So speaking of which, joining me, Mr. Tosaw. How you doing, Mike?
Doing well. How about yourself?
Oh, can't complain. I'm a happy camper. So what is going on in the world out in why am I having a complete brain drain right now? Where do you live?
I'm not going to help you on this one because of the fact that we are building an army. Ever since I gave that tourist guide to Longo a couple of weeks ago, I'm getting more and more people from lovely, sunny, scenic St. Charles, Illinois,
there you go,
coming to me, and I'm learning of the option trading community that exists out here. It is unbelievable.
You're like the grand poobah of St. Charles trading. So
it's like this secret little internet thing, but now all the people are coming forward. It's okay to be an option trader and live in St. Charles.
That's lovely, and that makes me happy. I just wish I saw the same thing out of all the other St. Louis's, St. Augustine's, St. Croix,
St. Lucia, St. Croix. You're right.
Yeah, where are those saints? So. It's exciting, but nice day, beautiful day, good day on the market. So with that, let's roll out of him and Mike and I talking to ourselves and roll into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
And welcome to the Trading Block. This is when we talk about stuff. And not the most exciting day in the markets. You had the S&P down $2.55. You had the NASDAQ 100 that was up 13. The Dow Jones Industrial ended up 1583, and the Russell down 415. VIX cash up 41 cents to 1691. Mike, what were you noticing in the markets today?
Well, we have a real busy week this week with the Fed announcement, with a couple of earnings announcements. There's a lot of things going on. So I think that what we're seeing at this point, it was not a very exciting day. So when you said it was a good day in the market, spoken like someone who's obviously short premium in some way, shape, or form. But in looking at this, I think that the market's just kind of sitting on its hands for the time being, waiting to see how some of the news that's coming out this week plays out. Some things of note: gold is down a little over 1% on the day, so that's pulling back a little bit. Oil is, I think, the big story of the day. Crude is down a little over 3%. So we had a little bit of bearish control, so to speak, in the commodity realm. But aside from that, there's really not too much that I would consider very exciting. A lot of the things, a lot of what the rest of the market is doing is up, but I think it's just with this commodity downturn today is what stopped us from having, let's say, maybe an 8 to 10 point uptick in the marketplace. In the S&P.
It was interesting. We've really seen a big break between kind of how oil moves and how the market is moving. Seems like the market isn't going to have a big rallying day if oil's getting slapped around, but at these levels, oil can sell off and the market doesn't necessarily have to. I think that's a bit of a change and one that we should definitely be noticing. I don't know. I mean, it's somewhat clear that's breaking, but do you think it's kind of a permanent thing, or is this just kind of, if oil starts to get back below 35, we're going to see them start to correlate again?
I could see that, but in reality, I hate to say it, but I'm the oil bull these days, so it's hard for me to possibly imagine oil going down that low again. But if we do go that low, I could see a correlation coming back. What I'm really focused on right now, Mark, is that we've gotten over the 2000 mark on the SPX, and I've been talking about that on these last few shows. But now I think the next hurdle for the marketplace is, can we go positive on the year? And I think that's a question that's going to be answered this week, because if the news that comes out this week doesn't push the market positive, then that's a concern for the bullishness in me. We had been talking about non-farm payrolls over the course of the last 3 months, and Andrew had said it best in that I don't see how this can possibly be good for the market with the unemployment report, non-farm payrolls, or whatever you want to call it, on or with all the announcements that come out on the first Friday of the month. And so the reason would be is that if it's good news, then people are concerned that, the Fed's going to raise rates, and it becomes bad news. But if it's bad news, then, it's bad news. And so either way, the market comes down. Now we're at a point to where we're right on the edge of going positive on the year with everything that's coming out this week. No, I don't think the Fed's going to raise rates this week, but the words that they're going to be saying this week, or what they say at the meeting, I think is going to be very important for what the market actually does.
Yeah, and I agree with you 100%. I commented that I wrote an article on the street, and I didn't think they were going to pick this up as much as they did. But I said the overall economy kind of reminds me of my puberty. There was some growth, just not as much as I wish there had been.
And that's a visual I could have really.
Yeah, and it was a little hairier than I would have liked. I think what the Fed needs to do is figure out, is there actual inflation, or are they trying to make inflation where there really isn't much? With Europe now in negative rates, and with Japan in negative rates, and with really China devaluing. And remember, China pegs to the U.S. dollar. So as the U.S. dollar strengthens, it forces China into a devaluating mode. So there is some real problems with Fed raising rates in the way the global economy is currently kind of structured. I'd love to see them come out and at a minimum get away from this data dependency thing. I think that of all the decisions that they've made, this weird data dependent piece is quite possibly the most damaging and market confidence undercutting. It points the market toward thinking these people have no idea what's going on. But can they get away from this data dependent piece, Mike? I don't know.
I don't see how they can at this point. I mean, they eventually in time, in several years, possibly, but they've preached the word, they've said data dependency so many times, it's almost more popular than the words irrational exuberance at this point.
Mm-hmm. Yeah, in a lot of ways.
So here's the other thing that I'm thinking we might have to look for this week. We haven't had, like a few months ago when Hillary Clinton said, if I'm elected, I'm going to hurt the pharmaceutical company, and then all the pharmaceutical stocks went down. We haven't had a bonehead political soundbite like that in a few months. I got a feeling one's coming. I don't have any evidence to base that on, but I just think we're due for one. We got primaries this week in Florida and Ohio, and this might be the end for Rubio. Who knows? But with that being said, times are getting pretty desperate on both sides of the aisle, in that I think that Cruz is going to do anything that he can to take out Trump, and Sanders is going to try and take down Clinton in any way that he can. So I think that in this situation, given the fact that we're at the point to where these other politicians are throwing Hail Marys, if Cruz says something that finally does go cross the line or whatever, Trump's not going to be shy, neither would Hillary, to Bernie, about coming back with something. And when we get to this intense section of the primaries, words can be said that might not necessarily be good for our economy in general, or they might be really good. Who knows? But I do think that in the stage of the elections where we are right now, we could see some type of a Hillary type tweet or post or something like that could have some damage or some benefit to the market in some way, shape, or form.
Yeah, for sure. For sure. And so I just don't know.
Don't know what it would be myself, but we're at the point to where the gloves are as off as they can possibly be, and that's when things can get said.
Yeah. It'll be interesting kind of what the next piece. So, it's obviously not the announcements of what they're going to say, and that's really it. Looking ahead, earnings don't look exactly, was there anything in the commodity space or any currency stuff? I mean, really, everything is Fed. I mean, I could talk about energy. Seems a little Fed-y. I could talk about the markets. I could talk about gold. I mean, I could talk about individual equities. What are you seeing anything that is really not? Is there any trading opportunities out there that aren't directly related to the Fed?
Maybe not directly, but there's pretty much everything's at worst or at best indirectly related to the Fed.
Yeah.
I mean, the only thing I have like with Apple right now, I got into Apple probably about $8 ago.
Nice. Look at you.
Putting a little collar on it. So I'm doing it in a very wimpy way, of course, but
now's the time.
Yeah. So, I mean, with Apple, I don't know I think technology is probably the only thing that I could think of that's not directly related to the Fed. But if the Fed, because Apple pays a dividend now. And yes. So it's tough because you can look at Apple, you can look at like Alibaba, for example. If we have policy that's affecting the dollar because of Alibaba's foreign ties, that can have some type of an effect on that. So I would like to say that technology does not have much to do with the Fed, but it's tough to even say that.
Yeah, I agree. I mean, they are, the question is, are they going to be able to figure this out? And, I just don't know. It may take a while. So,
well, if not, we got plenty of things to make fun of on the show in case they don't.
I know it'll be lots of fun. No particular earnings this week. We got 3D Systems before the bell, but that's about it. Nothing crazy. The other piece of kind of interesting news, ICE, the Intercontinental Exchange, saying that if they buy the LSE Group, they want to keep the London Stock Exchange, which was kind of odd. Maybe they would have kind of ICE would basically own all the iconic stock exchange. They'd own the LSE and they'd own the NYSE, both. More from a branding perspective, that's kind of the only reason why they'd want those, right?
That's what I would think, because like right now, a movement that's going on in America right now is that large companies are buying community hospitals. That's happening all over the country. And so what they're doing is they're keeping the big name in, but they're still keeping the smaller name of the hospital so people feel familiar with it because that's what they've had. But it's basically becoming McDonald's, but they just keep the local hospital name. And so that would be the only reason that I would think as to why they would want to do that. So more power to them, I guess.
Yeah, kind of interesting. And with that, let's leave the trading block and move into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the Odd Block. So a couple of interesting trades. First trade, BBD, Banco Bradesco SA. It's an ADR based in Brazil. It's a Brazilian commercial bank. Trade about $7.50 and average daily volume of a couple thousand contracts. The open interest of about 115,000 contracts. And that's partially because on Friday, a trader came in and bought 55,000 of the June 6 puts. Well, guess what? Today, maybe a different trader, probably the same guy, buying another 55,000 of those June 6 puts. All told, the trader is now holding 110,000 June 6 puts, representing about 60 plus % of the open interest in this name. Obviously, Brazil having all sorts of funness going on right now. Dilma Rousseff looks to be in some trouble. PBR is a mess. Petrobras, and really the currency, the banking sector, nothing going right for the Brazilians. What do you? Any thoughts on Brazilian banks and or the Brazilian economy? I'm sure you did some reading on your girl Delma.
Well, you're keeping it real, Mark. Get it?
I get it. I get it.
But I mean, with this, it just looks like someone really likes that stock in some way, shape, or form. So it represents 60% of the open interest of this name. Then this could be a Warren Buffett style trade of selling puts to get into it.
You think they're selling? Interesting. Okay.
Well, it says right here. Well, someone sold them.
Yeah.
I mean, do we have any?
No, it was a buyer of these puts, but they were doubling their short exposure. So I think it's a hedge. Yeah, I think it's a hedge. I'm sorry. It's either a hedge, or it's somebody saying this thing's going to crap.
Yeah, I would bet going to crap based on what's going on in there.
Sure, yeah, exactly.
So got it.
It's kind of an interesting one though. Although that would be if that was a put sale, and who knows, maybe you're right. That would be a Balzania put sale. I mean, that is just a good one. All right, now this is one you're probably a little more familiar with. CarMax. Big fan of the CarMax. Trade about $50. Trader did a 1x2 put spread, and I know that you love your 1x2s, Mike. Trader bought 6,000 of the April 50 puts, paying $240, and then sold against it 12,000 of the April 45s at 85. Net debit of 70 cents. I'm looking. KMX, they do have earnings, I believe, before they do. They've got earnings before April expiration, so it's an interesting one.
Yeah, I like trades like this because this is one where normally I would prefer to do this one for even money or a small credit.
Right.
But on here, what I like about this trade is that it's pretty much impossible to lose money so long as it stays above the low 40s. And so by setting it up this way, you have the ability to where if the stock stays the same, it's pretty much nothing. Stock goes up, but you're not really going to lose anything. In this case, you would lose your debit. But if it does go down a little bit and has a little bit of a pullback in the earnings, which is what it appears this trader is looking for, then you got a really inexpensive way of getting into that stock, or you'll make a little bit you have the ability to make something very nice for a very small amount of debit risk. And if it does go down that far, the trader probably thinks, well, I'm happy owning it anyway at that level.
Exactly. It's great. It's a great play. It's a really professional play. Now he's probably he's paying for it because he's setting up so close to the money. So there's some give and take in that. The good news is he gets his protection a lot earlier. The bad news, obviously, he's paying for it.
True.
And so that's that. And then next one, we got Delta Airlines. I'm sure you've heard of that. We had a nice big call roller. A trader that was short the 48.5 calls in March, covered them, and then sold the April 48 calls, paying 37 and collecting 142 respectively, thus kind of a $1.05 credit. So customer thinking, hey, this is a name that I like, and I think it's going to sit here for a while. Looks, kind of a straddle-y type trade. A pretty decent, but looking to collect an income. He's getting $1 against $48, so $1.05, $1.40, however you want to look at it. So 2.5% return if Delta just sits here against a $48 stock. That's not a terrible call override.
No, not at all. And sometimes airlines can really do well with this. A few years back, I did this on Southwest Airlines for several years, actually. And it was several years ago when I actually did it. It was the last time I ever played in the airline stock significantly. But, the benefit of this is that if oil prices do spike in one way, shape, or form, this is one where you might get some type of market movement to help hedge the airline stock from going down, because airline stocks aren't always inverse of oil plays, but a lot of times they are. So combine that with getting that premium from month to month, and I think I like this play.
Yeah, it's not bad. Not bad at all. So that is our odd block. And with that, I'm going to kick back. I'm going to maybe watch a cat video. And I'm going to let Mike talk about strategy in the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the strategy block.
All right, Mike, it's up to you. It's time for you to get your strategy on like the giant strategy master that you are.
The giant strategy master with which I am. All right, very good. Let's talk about short put spreads today.
All right, let's talk about short put spread. I love me some short put spreads.
What's not to love? I want to go through the advantages and disadvantages of selling put spreads along with vol skew and how this can actually work in the real world. So let's start off. What I am doing right now is I am taking a look at an option chain with implied volatilities. I'll just say 1 week out for the March week 4 SPY options, and I'm looking at various implied volatilities on them. So as I look at them, at the money, the implied volatility on the 202 half put, I'm showing it's just under 17. And then the further in the money with which, the further out of the money with which I go, meaning the lower the strike price, typically the implied volatility becomes greater and greater. And that's what's known as the vol skew, in that the further out of the money you go with the puts, because there's more paranoia at a lower level, puts are theoretically more expensive because most of the buyers of the puts are more concerned with the market just falling out of bed and having a 40% drop in 1 day, let's say. Well, not 1 day, but maybe 2 days. But anyway, with that, how does this actually apply to a short put spread? Well, the advantage of selling a put is that you'll get premium. That's the only advantage of selling anything. So if you sell a put, let's say right now SPY is trading at 202 half, you can sell the 200 put. And by doing that, you actually have a little bit of cushion, and you have the ability to make money should the stock go up, down, or stay the same. It just can't go down too much. And that's assuming you want to hold the option till expiration. That's the beauty and the advantage of selling a put. Now, the disadvantage is that if you want to make, in this case, $1.40, you have to risk $200 to do it. And by risk, I mean, granted, you can get a portfolio margin account and not have to put that much up in maintenance. You can do it whatever way with which you want. But the bottom line is that your true risk on the trade, not your maintenance requirement, if you have a margin account, your true risk would be $200 to make the $1.40. So because of that, a lot of people are attracted to the put spread. And with the put spread, let's say that you don't want to take on $200 worth of downside risk. You could say, I want to also buy the 195 put for 45 cents. And so instead of making $1.40 on a $200 risk, now you're making 90 cents or 95 cents, I should say, on a $5 risk. And so the risk reward is obviously much more beneficial based on those odds. Now, of course, the market doesn't have to go down as far for you to lose 100% on the put spread. So you have to weigh all those factors as you're making this decision. Now, here's the point with which I want, and this is, for most of our listeners, this is something very basic that you already know. But here's what I want to point out about the put spread. If I were to do this imaginary 200, 195 put spread, I'm selling the 200, buying the 195. I'm selling an option with a 17.25 implied volatility, and this is according to the Thinkorswim volatility calculation. And this isn't designed to be an exact volatility, but this is just to kind of give you an idea of it. The concept is something that would be very true in pretty much any volatility model. So I'm selling volatility that's at 17.25. I'm buying volatility at the 195 level that's at 19. So because of the fact that I'm setting up this put spread, I'm buying something with more juice in it than what I am actually selling. Now, granted, the actual price of the options is set to where if the spread is out of the money, it'll expire worthless and you'll make a profit. But you are paying for that based upon the implied volatility that exists within this spread. So oftentimes, people who are against selling a put spread, that is why they're against it. And quite frankly, that's why I'm against it too, unless it's set up in the way with which I'm about to explain, which I've talked about on the show before. I want to go over again today. So the further out you go, let's say that I were to go to, instead of next week's expiration, let's say I go to December 31st. December 31st, those same strikes, the 200, it has a 17.95 vol, and the 195 has an 18.92 vol. So you still have that. It's not quite as much of a difference, but it still exists pretty much in any time frame with which you'll go to. Now, here's where it can get kind of interesting, and here's where last year I really had a lot of fun doing this with weeklies, and haven't really had as much fun doing it with weeklies this year because the market hasn't cooperated, and it hasn't given me the ability to do it as much as I would like to. But this is where what I like to look at when doing so with a weekly. Let's say that I were to go to those same strike prices right now, selling a 200 put for the front week, meaning this Friday, the 200 put on SPY, I could sell for 87 cents. And full disclosure, I don't have any of these positions right now. I'm just kind of giving you a look into my world of how I look at things when I'm selling premium or selling these put spreads. So the 200 put right now, I can sell for 87 cents on SPY for this week. And the 195 put I can buy for 16 cents. So with that, this is a pretty intense vol skew here as well. The vol on the 200 put for this week is 19.5, and the vol on the 195 put is 21.5. So it's the same conundrum with which it existed before, but here's the difference. This is one of the few things, and I talk about this in my weekly chapter in my book, in the second edition of my book that came out a couple months ago. This is where it comes into play on the weekly side of it. Yes, that same vol skew exists, but what the difference is that 195 put, it's only 15 cents. So yes, the vol is there. The vol skew exists. I'm paying for something higher than what I'm selling, but it's only 15 cents. And a lot of times you can get away with it for less than that, just depending if we have a lower volatility environment, with which we did at times last year. There was a lot of times with which the hedge leg of my put spread, it would be tremendous, insane implied volatility that I was buying, but a lot of times it was only like 3 or 4 cents. And I'm getting 50 to 60 cents on the credit leg of the put spread. So I'm okay paying that extra penny to get that vol skew. I'm okay with that. In this case, now that we do have higher volatility than we did for a lot of the time last year, what's happening is that it's a little bit higher. But my point is that if you are going to sell a put spread, number one, if it's going to be 1 to 3 months out, be aware and be very mindful of how that exists. Make sure that it makes sense for what you're doing, and have an understanding of volatility, how it expires, and that type of thing. And Mark Sebastian knows of some good courses that can teach you about that. But the second thing with which I want to mention is that in the world of the weeklies, there's a lot of gamma risk that exists. You need to be prepared for that in terms of what you're going to do if the trade goes against you, how you're going to handle it, that type of thing. But what I personally like about the weeklies is that a way with which I can hedge my short putting, so to speak, my short putting. Ooh, pudding. That's maybe something we can make a play on words with that in some way. I'm sure you'll have plenty of ideas for that when it's your turn to talk again, Mark. But
well, I was going to ask if it's vanilla short pudding or chocolate short pudding.
I figured you'd have some question on that.
Yeah. So if you're short pudding in Hershey's, is that like Texas hedging?
Oh man, that's a tough one.
There you go.
With this, the fact that this is one area with which I feel comfortable taking on the gamma risk of the weeklies, because of the fact that I'm paying for the higher volatility, but it's only a few pennies. To me, that's something with which it makes sense. And I have my other techniques with which I'll get out of it and manage risk and that type of thing, which I'll talk about on the show. But the main thing that I think makes selling a put spread work in the front week would be the fact that the hedge leg, although it does have the higher vol, it's not by that much of an amount from a dollar standpoint. And that is the strategy for today on short putting. Next week, we'll talk about putting with, I don't know, we can go a lot of ways with that. We'll figure out.
There's all sorts of different ways of going around that one. That is all sorts of interesting pieces.
Yes.
Let's roll out of that amazing strategy block, and we got a couple of minutes here. You want to take a couple of listener questions?
Let's do it.
All right, let's roll into the listener question block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, and if you can't figure out what the listener question block is, please stop listening and stop trading forever. Really. And, now, this is a question from Bob. I've heard pros say that when too many retail traders jump into a trade, then do the opposite. Does that apply to options as well? You want my answer first, or do you want to answer first, Mike?
You go first on this one.
In short, yes. When you, the shoe shine boy or the paper boy or the doctor lawyer, guy makes the comment that, I bought all these options in Apple. Yeah, it's getting near, that trade's getting long in the tooth, and it's probably time to flip out.
Yeah, and I would agree on that one too. And you probably have stories of this from the floor. I've always heard about the army of ants, when all of a sudden in XYZ stock, you see one lot after one lot after one lot coming into the floor on a certain stock at a certain limit price that may or may not even make sense at the time. A lot of times that's an auto execute type of thing. And how do you guys do with auto execute people when you were trading on the floor? Mark, what do you guys do?
We creamed them. It was great.
That's pretty much everything that I've heard on that one. So that's another situation to where on the auto executes, when you get a lot of people doing it one at a time. And so to answer your question, Bob, if a lot of retail comes into something in an option trade, I would agree as well.
Take the other side.
Yeah, and I actually have. I'm not good. I have a pretty nice little Rolodex of clients with whom I talk to fairly frequently, and there's some of them that are right very frequently, and some of them are wrong very frequently. And I've told the clients this, and some of them are just inconclusive. But there's always I do have indicators in terms of I don't really put too much. I don't put anything into it. I don't do my research this way, but there's times to where if ever this one guy was talking about how great Apple was, it was pretty much like clockwork. It would go the opposite way.
Oh, that's funny.
And there's another guy that whenever he starts whenever he's trying to trade momentum, then meaning he's starting to buy calls as the market's starting to rise, it's almost a surefire bet for
it's all over.
Yeah. But the same guy, whenever he starts buying puts because he thinks that a rally is over, he's almost always right.
Oh, so that's interesting.
It is. I have a whole grouping of clients that are self-directed traders that work with us and ask for advice from time to time. But I'll never tell them like what how their ratings are, because most of them are inconclusive, but there's a few of them that are always either right or wrong in certain situations. There's a gentleman that I used to work with. He was right almost 99% of the time whenever he would tell us a trade. But whenever he would actually put a ton of money on it and be very convinced that his trade was right, no matter what it was, 100% wrong.
Mm-hmm. You know, and the one thing I would throw out is that if you hear a lot, especially on a specific option trade, if you hear about a lot of people buying one specific option, even if you think the underlying concept is right, find a different way to execute the trade, because you probably want to sell them that option instead of buying it. All right, now this is a question from 777. Apparently, he big fan of Boeing. What are the industry sectors least positively correlated to the major indexes? Are there any quirks to trading those using options? And I will definitely leave that to you, to let you throw that one out first, Mike. What are your thoughts?
They vary at times. I mean, right now, a lot of people like utilities because they're more stable, so to speak, or the last couple of months they're more stable because they've paid they always have they're more of an income-based trade, but that changes from time to time. What we talk about all the time on the pretty much any financial news media would be how oil, and even we talked about today, even oil moving the markets in one way, shape, or form. 3 years ago, no one would have given a crap about what oil's doing, but that's just the way it is today. So in terms of what are they change, and they change quite rapidly, quite frankly. In terms of are there any quirks to trading those using options? Well, with this, a couple of things with which you can do on it. I personally like to hedge baskets of stock based with S&P. So, for example, we have something at RCM that we refer to as the strategic night. I have absolutely nothing to do with what stocks are picked for the strategic night, but within the hedged strategic night, I hedge it using options.
Oh, nice.
So I'll hedge it using SPY options. And so with that, I think that what would make the most sense is, let's say that you're really hot on pharmaceuticals, maybe overweight pharmaceuticals within your portfolio. So instead of, you normally have, I don't know, I'm just making up a number here, 12% in pharmaceuticals, maybe make it so you still have 24% in pharmaceuticals, but you're still using options on the S&P as a hedge or as a way of getting income if you're selling call spreads, put spreads, whatever the case may be. So that is my take on it.
I like it, Mike. And with that, we'll now that we've hammered two great listener questions, let's roll out of this and let's look at what's going on around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
And of course, this is when I'm gonna Mike and Mark are gonna tell you what they think's what's important that's coming up. I'll quickly go through a couple of things. We've got earnings. So Tuesday you've got Oracle, DSW, Gerdau, HD Supply, Constellium. Wednesday you got FedEx and Williams Sonoma. You got Adobe on Thursday, Aeropostale, and Tiffany and Company. So little off cycle earnings coming up. Adobe and Oracle definitely are ones that could move things around. Certainly if this wasn't a Fed week, they would be making some real headlines. Mike, anything else you're watching for around the block?
Yeah, a couple of things. I'm curious to see GW, the marijuana the pharmaceutical stock that has the treatment for, I believe it's not, epilepsy, that's related to marijuana. That stock doubled today.
Yeah.
And so I'm curious to see how that continues, if it does continue. That just kind of more out of curiosity. But the other one that I'm watching, I talked about on the show last week. I wish I still had them, but you know how on New Year's Eve you always wear the year, those glasses with the year on it. I wish I had my 2000 glasses because I'd be wearing them right now. But just in regard to the S&P 500, and that we need to hold 2000, folks. If we want to continue to rally, we need to hold 2000. And then, like I said earlier in the show, the big stumbling block or the big hurdle that the market's going to have to face is going positive on the year. And if we can't go positive on the year with the news that's coming out this week, then I think it's going to be a lot harder for it to happen.
Yeah, I mean, I would agree. You definitely have a lot of that GW thing was just insane.
Looked a lot of people are high on that.
Total lemming trade. That's a scary one. I'd let that play out before I'd hop in that one. But yeah, obviously you got the Federal Reserve. I think it's really important what they're going to say, and they're going to determine whether or not it makes sense for us to be, how we should approach the way they're trading everything. And it's pretty fascinating the way things are lining up. So yeah, that's going to be the big thing I'm going to watch. I'm Fed, a couple of earnings, and that's it.
And just a side on the GW stock, a friend of mine that has absolutely nothing to do with the financial markets texted me today and said, "What do you think about this stock? It's going like gangbusters."
Exactly.
So that should give you some clue on it right now.
Yep. Now, here's my question for you. What's going on at RCM?
Oh, lots of stuff going on at RCM these days. It's IRA season, folks. And if you're not sure how to contribute, what to contribute, or if you should contribute, give me a call, folks. Happy to work with you. If you want to work with someone who is a financial advisor, but yet still understands options, which is kind of the exception and not the norm in the financial advisory profession, give me a call. Send me an email, 312-212-3531, or send me an email at mtosaw@rcmfs.com.
Yeah, and here at Option Pit, just keep reading the blog. We should be pushing an email out in the next day or two, inviting everybody to an Option Pit webinar. And we've got some fun stuff coming up in the next couple of weeks. And now, I don't know if you know this, but there's this little tournament going on, Mike. That's going on. Yeah, I know. You never heard of it. It's a unnamed college basketball tournament involving college players. And you can they're doing the March Madness poll where you can vote on your favorite brokers as opposed to college basketball teams.
Ooh.
Voting starts on Tuesday. You can go to the optionsinsider.com for voting on your favorite broker. So, Mike, if you're not going to vote on your favorite broker, I mean, who cares about things like college basketball when you can vote on your favorite broker? So I'd encourage everybody to do that. And with that, I will wish everybody a wonderful day and a wonderful week. And for Mike Tosaw and the missing Mark Longo and everybody at Option Insider, this is the Option Block. I'm Mark Sebastian. Have a great week.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.